Hello there, Adam Gower here, and welcome to the GowerCrowd Podcast, the real estate crowdfunding show Deal Time, where you can learn about active crowdfunded real estate deals directly from the sponsors themselves. Subscribe to my free weekly newsletter at GowerCrowd.com, where you'll get links to the podcast, as well as news and updates exclusively from the world of real estate crowdfunding. Sign up at GowerCrowd.com so you don't miss out. Also, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and look for links on how to submit your deal. Please note that while I don't endorse the deal, sell securities, or make investment recommendations of any kind, some sponsors are GowerCrowd clients. Now listen in and learn about the next great deal on the GowerCrowd Deal Time podcast. Here we go. Brit Properties. Co-sponsor deal in industrial real estate. Oh my goodness, I've been so looking forward to recording this podcast. Let's start off, if you wouldn't mind, please, Joel, Eric, and Austin, just give me a quick background, name, rank, and serial number, what you do on a daily basis over there at Brit Properties, and then we'll roll into the deal. Joel, why don't you start?
Sure. I'm Joel Friedland, and I am in the industrial real estate business. Industrial real estate means manufacturing and distribution facilities, and we specialize in the Chicago area, where we know almost every single broker of the 500 brokers who do the leasing and sales of these properties. But more importantly, we also know a huge percentage of the 20,000 industrial companies that occupy the 1.3 billion square feet of industrial property in Chicago, because we literally have people going door to door and making phone calls every day to find deals and find tenants. We're immersed in the market.
Eric, name, right?
I'm Eric. My name's Eric Schneider, and I'm one of those people who are going door to door every day to find deals. I'm currently managing the Brit Properties portfolio, handling brokerage and acquisitions as well. And I am a partner in Brit co-sponsors as well as an investor.
Lovely. Austin.
Austin Garwood. Bit of a Swiss Army knife over at Brit Properties. Handle all of our financial analysis, underwriting, work hand in hand with Eric and Joel for asset management and whatever else that we have going on that we need to figure out.
Right now, you have 15 minutes plus or minus to sell me on the co-sponsor deal. So let's start right at the very top. What's the deal? What's on offer?
So Brit co-sponsors is a group of people, mostly our closest friends and investors, but we are looking to open it up to a new group because networking and building our investor base is very important to us. So we currently have about 20 investors in the deal, and we're looking for a few more, but it's got to be the right fit. It's got to be somebody who understands what our game plan is. We are buyers of industrial properties, individual properties, one by one by one. And what we've done is put together this group to have the cash to be able to go buy the buildings very quickly, the quick close, convincing sellers that we are completely credible. And when we use the funds from the co-sponsor group, we buy a property, and then after we own it, that's when we syndicate it to an outside group. And for putting up the capital with us, those investors share with us in the various fees that we make as the sponsor. The people who get rich in real estate are sponsors. What happens is if you are a developer and you put deals together, you make fees. And what happens to those fees is they make the one side, which is the group that put the deal together, a lot more money than the people who are the regular investors. This is an opportunity to be with us on the sponsor side and share in those fees.
Right. So, Austin, why don't you tell me the 9 ways, extraordinary number, 9 ways that investors can benefit from participating in your co-sponsor offering?
Can I add? I would run through them very quickly and then see if Adam picks any of them that he may be most interested in hearing more detail about.
Sure. Yeah. So just kind of piggybacking on what Joel was saying there, the sponsors have a lot of streams of income as opposed to just being a limited partner in a deal where, your returns are based on cash flow distributions and some profits on sales, if any. But through being a co-sponsor, we've added another 7 because these people are getting a piece of all the fees that we're charging along the way, which is typical of sponsors. So we have properties that we might flip. So, purchasing an industrial building and maybe we're selling it to the neighbor within a short period of time. So proceeds from flips are split between the investors and then the manager 80-20. Then with every property, we have acquisition fees. So those acquisition fees will be charged to the later group of investors. So the co-sponsors are going to split our acquisition fees 50-50. Then we have some interest while we're holding the properties before they're syndicated, which is going to be about 4% annually. So the co-sponsors will get all of their interest on their money. Another fee that we'll have is assets under management. So we'll base that off of the equity in each deal. We're going to have a low asset under management fee on all of our deals, probably about 0.5%. And those will be split 80-20. Then we'll have property management fees because we're vertically integrated. So we're owners and managers. So we do all of our own property management. So those will be split 80-20. So then we have construction management or project management fees, which is a fee that we typically charge for large repairs or improvements to a building. Example, putting on a new roof. It's usually 7% of the project cost. That'll be split 80-20. And then you're also going to partake in, your normal limited partner distributions. So you're going to have cash flow distributions from the remaining equity that we have in each of the deals, which will be about 5% that we'll leave in. Then our waterfall distribution structure for each of the deals, we'll probably be around a 7% preferred return with like an 80-20 split. So that 20 of the promote on cash flow, the co-sponsors will take part in our promoted piece. And then you have promotes on sales. So they'll just same as the cash flow, they'll partake in the promote from sales proceeds. And then obviously as a limited partner, you'll be getting proceeds from any profits that we make on a sale, your pro rata share. So you have those are your 9 different streams of income that we've built into this. And it should be great.
Right. And what are your wiring instructions? It's the only question that I have next. No, I'm kidding. Right. So the way that this thing works, you've drawn a pretty cool chart of this. So give me actually Joel or Eric, either of you, give me a big picture perspective. I'm going to paraphrase what I think it is that you're doing, but I want you to tell me exactly. So the co-sponsor interest is a pool of money. Tell me how much exactly. And then as you acquire buildings in short order, the idea is that you will backfill with individual investors going forwards to return that capital so that it constantly is recycled and works long term. It just keeps on rolling. But as you do that, there are all these fees and there is an ownership tail that stays in each deal. So just explain to me kind of high level the structure.
First of all, though, it sounds like, wow, what a lot of fees. The actual fact of the matter for the investors in this particular deal, which is the co-sponsor deal, is we're charging them no fees. I don't think anyone's seen a sponsor put together a deal where the organizer, which is us, charges 0 fees to the investor. So that's the first part. They're sharing in our fees, not being charged our fees. Completely different approach. But the idea is that we find a building. For example, we have one in the city of Chicago that we're buying right now for $3 million. And we use this, the total amount of the fund that we're using for this, the co-sponsor fund, is $10 million. We take the $3 million and we close all cash. The seller loves it. We have no bank. We have nobody breathing down our neck as far as saying, if this doesn't work out the way it's supposed to, you're at risk of default. There's no default. It's all cash. So it's great for the investors in this deal because they have the greatest mitigation of all, which is an all cash deal until we syndicate it. And once we own the property, then we put together a private placement memorandum. And these investors in the co-sponsor group are on our side. They are like, if there was a casino, there's the house and then there's the players. These folks are part of the house. And so we syndicate the deal and we charge the fees and we figure out the disproportionate shares of profits, and they share in all of that all the way along the line as long as we keep doing this. It's a 2-year commitment. So over a 2-year period, we're going to continuously recycle that money. And then in each deal that we buy, the co-sponsors and we will own 5% of the equity. And every one of those deals is going to be limited to an average of a 30% loan to value ratio for safety's sake.
Plus, of course, investors in the co-sponsor scenario can also invest as much as they want in individual projects as well as investors.
And in fact, they have a right of first refusal before we go to outside investors. If we hit a home run, the investors in this group are going to say, why would we syndicate it out? It's the greatest deal ever. We once bought a building from the Keebler Cookie Company, and we very luckily found Comcast, who signed a 15-year lease. If we were in that period before syndicating it, we would give it to the investors in the co-sponsor group, explain the deal, and say to them, the return on your remaining equity is going to be 40% a year. Would you like it or not? And that's the opportunity that they have, is to look at the inside scoop before deciding if they want to buy into the deal or if they want to let us syndicate it. And they just remain as part of the 5% ownership group that we have collectively.
Right. So now, Eric, why industrial? And behind that question, actually, is the tenants. So tell me about why industrial, right? We all read about it in the news, right? It's being the hot thing. But tell us the inside scoop.
Industrial real estate is the largest real estate sector in the country. In Chicago alone, Chicago is the largest industrial real estate sector in the country. There are 1.2 billion square feet worth of industrial space, made up of over 20,000 companies who are using this space. It is the highest returning real estate out of any real estate sector. And we have in-depth and detailed market knowledge of our of industrial real estate in the Chicagoland area. I mean, super ultra detailed expertise when it comes to the players in the market, the owners.
Eric, your connection, we're losing your connection a little bit. One of the hazards of WFH.
And the tenants.
Eric, I can barely hear you.
Tenants ranging from
Eric,
yeah.
can barely hear you. Let me what do you call it? Divert the answer to that question back to Joel, if you don't mind, just because of the Wi-Fi. We've gone back to those 60s karate movies. I can barely hear you. Joel, why don't you just jump in and help fill the gaps there that Eric was talking about?
Sure. Well, as Eric said, there's over 1 billion square feet of industrial property in the Chicago market. And every property has a different kind of tenant. Any product, you pick your favorite product. Tell me anything that you like to either eat or do something with, or that's in a machine that you have, or your car. Every product is made in an industrial building, and all of the parts are made in industrial buildings, and then they're distributed in industrial buildings. Of course, the biggest one that everybody knows is Amazon, and they occupy, this is crazy, 270 million square feet of warehouses. In the Chicago area alone, they've eaten up over 10 million square feet. But that's not our kind of tenant. That the returns on those deals are not as good because it's Amazon, and people say, oh, I'll take a lower cap rate. In our kind of properties, we have very unusual tenants. My favorite story is that we have a company that was on Shark Tank. In the first year of Shark Tank, they make protein bars, and they've got these machines that just pump out protein bars that are customized bars with any kind of ingredients. And they have people working the machines, and they have conveyor belts, and they're in a 50,000 square foot space. And it's funny because not only was he on Shark Tank and grew the business 100 times in terms of revenue, but the tenant that was in the building before that was a company that made croutons for McDonald's. It was called Best Croutons. So what happens is we get these really unusual tenants, and each one has a backstory. And there's something called onshoring or reshoring, which is where a lot of products that used to be manufactured overseas, in China, for example, there's a lot of geopolitical reasons why those companies are coming back and making their products here. And every one of them needs one of our buildings.
So let's get back to the co-sponsor. Now, we've been talking about industrial real estate, and we have the corporate profile. If you want to learn more about that, go to GowerCrowd.com. You'll find the corporate profile there for Brit Properties. Drilling down now on the co-sponsor deal. One of my questions is, what's the exit plan? What does that look like?
We sell buildings to users. It's a very, very difficult concept to explain to a typical real estate investor, because a typical real estate investment is bought as an investment and sold as an investment. And it's sold based on cap rate. So cap rate is the multiple or the return on investment. Industrial is so different because we are in what's called B and C industrial. All these buildings are occupied by various tenants, and for them, the building is a tool for their business. They can't run the business unless they have the exact right building. And it's all about the geometry. If there's a building in the right location that's the right size and the right shape with the right amount of parking, I was telling Eric this last night. If someone comes and looks at a building and they manufacture some kind of parts that are involved we have someone who makes the machines that make the cups for yogurt. Yogurt cups get made somewhere, and there's someone who makes the machine that makes those. If the company that's a family business comes and looks at one of our buildings and it's the perfect building, I could punch the guy in the face and call him names, and he'll say, "Thank you for punching me. What do I need to pay you for the building?" It's not like a house. You can go to the next house over or down the street. Industrial is specific. And so what happens is when we sell to users, it's a 30% premium over the value that we would sell to an investor. So of the 73 buildings we've sold over the years, we have sold 68 of them to users. And every one of those sales, for one reason or another, is a triple or a home run, because we don't sell them until we find the right user. Meanwhile, it's like a covered land play until we sell them. We've got a great tenant throwing off yield of 7 or 8 or 9%. So people are collecting their distributions until the exit, which is to a user. It's magical.
Eric, I can see you teeing up to say something. I can't hear him at all. Eric, we can't hear you. Wi-Fi's dead. All right, so let me ask you this. Projected returns. What are the projected returns? And what's in it for investors? Got like to the nitty gritty. I bought in, but how much am I going to make? Projected returns, please.
Austin, why don't you cover that one?
Sure. Yeah, our targeted returns annually are 12 and increase every year up to about 14%. Our targeted IRR is 20 to 22%, obviously depending on, certain variables, how many properties we end up getting, vacancy, whatever. But we've gone through a lot of different scenarios, and those are the target.
Okay, and what is the time horizon? What can I expect if I invest $100,000 today with you, $500,000, whatever it is?
Sure. So for this structure that we have set up, it's a little different because your time horizon isn't necessarily when we end up selling a property, right? So because we're syndicating them out, a lot of our investors' money, unless they choose to keep it in a deal, is going to be returned to them after that 2-year period. So I'd 80 to 85% of the money will be returned after 2 years. And then the remaining ongoing equity, that equity tail that we have built into there, is about 20% of the initial investment.
Right, next. And as we wrap up, a couple final questions here. What's the downside to investing in the co-sponsor deal?
We call it getting stuck. It's a bad thing, but it's not very bad. That's the beauty of the structure of this. We buy buildings all cash, and then we go to syndicate them. If there's a problem syndicating a property, when I say a problem, let's say that the market crashes. Let's say the stock market goes down 25% and companies stop expanding and the whole industrial market slows down and the world looks like it did in 2009, which could possibly happen. We then own a building all cash, and it gives us a tremendous amount of runway because there's no bank breathing down our neck. We can lease it to somebody, and the return may not be as good, but the chances of losing the equity are very, very slim when you have no bank. So that's the key to this deal. Is we've tried to structure, I know it sounds counterintuitive, but we tried to structure a deal that would be a high return and a low risk. And that doesn't happen very often. The only reason that this deal is special in that way is because the investors are not being charged fees. They're sharing in our fees, and that enhances their return while mitigating the risk, because the worst case is getting stuck in owning a building all cash.
Yeah, and I know you like to talk about the downside and to be pragmatic, but I'm going to ask you to wrap up with the upside, if you don't mind. And in this context, $2 trillion of infrastructure spending has just been approved. We are coming out of COVID. $2 trillion has already been spent. It's just extraordinary numbers, right? You have a building, you talked about it earlier. I'm not sure if it was in the corporate video or if it was in this one, but Comcast is coming to the end of their lease. It's, 100,000 square feet. Again, you're going to have to fill me in on the details a little bit. You put it on the market for lease. Tell me what happened. The upside.
Well, nothing's happened yet on that one, but it turns out that the world has changed since we made our lease with Comcast. Comcast needed a building that had 650 car parking, which is incredibly unusual in this particular location for their Xfinity vans and for their warehouse people and for their customer service call center. They signed a 15-year lease, and because of COVID, they ended up not needing to keep their call centers all around the country. And so for 15 years of a lease, we've been getting a wonderful return, and they've been a great tenant. But when they leave, we have to reposition the building. So we have determined, and Eric is frozen there, he would love to tell this story because he's come up with the idea, that we're going to make this into a truck facility. There's a long wall, and then there's this giant parking lot where trailers can be parked, and we put it on the market. And I will tell you that no less than 40 different trucking companies are banging our door down to either buy or lease that building. So we're rolling with the times. The trucking business is booming because of e-commerce. And because the market's doing well with the infrastructure dollars and the economy being pumped up, trucking is just becoming even a bigger industry. And we're focusing on what to do to make sure that we get the highest rent from the best trucking companies. It's going to be a home run because of the trends.
And are you seeing this portfolio wide in terms of demand for industrial properties?
Yeah, we're 100% leased right now, which is really somewhat unusual. We don't go through periods of 100% lease for very long, but yeah, we see that the demand for industrial right now, industrial is the hottest market. If you read all the periodicals and all the emails, industrial is booming. We just happen to be in this. We didn't jump into industrial when it started booming. We've been doing this for 40 years, and now is our time. And so this is the time to own these kind of buildings. They're clamoring for our buildings. I don't think I've ever seen anything in my lifetime like this. Building comes on the market, dozens of people want to look at it, and then they fight over it. So it's been great, and it's because of the trends. The trends in the world have gone our way. We're very lucky.
Right. Last question. So you're raising 10 million. What's the timing? This is for the co-sponsor opportunity. What's the timing of the co-sponsor opportunity? What opportunity to have people to get in?
We think that the next 60 days will be the period of time that we're going to have the new investors join us. Okay. We're going to want some Q&A. We want to get to know an investor personally. We're very hands-on, and we really value our relationships. This is not going to be someone who sends us a check. It's going to be somebody who gets to know us and understands and believes in our mission and likes our team.
Fantastic. And on that note, thank you very much indeed. Good luck to you with the co-sponsor deal. It sounds absolutely amazing. For anybody that wants to get in touch with the Brit Properties team, go to their amazing brand new website, britproperties.com, or to GowerCrowd.com, where you will find everything you need to know, including the special sponsor background video that we also just recorded. Thank you very much, gentlemen.
Thank you.
Thank you.
If you want more information on this deal and on all the others in this new series, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together for you, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It's totally free, and it is the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet, all there at GowerCrowd.com. Thank you for joining me and for listening in to today's deal. This is Adam Gower wishing you well and signing off.